Hey guys, welcome to Chart This with Dave Keller. It's Wednesday, April 9th, and thanks so much for joining me here on our daily market recap show. I'm your host, Dave Keller, and coming to you from a beautiful Olympic Peninsula in the northwest corner of Washington. The fog has cleared up a bit, market wise, and also visually here in the rainforest of northwest Washington. We can see Vancouver Island across the strait here, which is pretty beautiful. Funny story. I checked the markets this morning. Things looking pretty normal, kind of consistent to what we've been talking about. Go on a hike for a couple hours with my family in the Olympic National Park. Super muddy, by the way, but awesome. Fun conditions. Took the dog. We got all messy. And by the time I get back to the car, figure I check the phone one more time. And all right, well, the game has changed once again. So I'm, rubbing my face as we start looking at all the numbers as they come in. Boy, what a fascinating time to be engaged in the markets. What a fascinating time to be navigating these markets with all of you. I mean, as we've warned here, volatility is going to be the new normal, and that means sudden moves to the downside. It also means on a day like today, sudden and severe moves right back to the upside. This was a crazy day. And when I tell you this is incredibly rare, a day unlike I've seen often in 25 years, I am not exaggerating. It is a pretty wild day. I mean, and again, I tried desperately to stay away from political commentary. Certainly not my goal with the show. We have to go there at some point. I mean, if you're the reason why volatility is going to be the norm here is just within the last week, you can see how easily the market can be manipulated if you're in the right office and you have your own social media platform and you can drop headlines to shock the market to the downside and then easily shock the market to the upside. Even when a couple hours earlier, you've given a heads up to everyone on social media that you're going to be doing it, and then you actually go ahead and do it. These are crazy times. This does not make me feel particularly comfortable about risk assets at the moment because volatile periods can be super challenging. However, let's do our best to unwind what we learned, or I guess run down what we learned, and just try to get a sense of where we're at here. So this is where the markets finished off, as I'm sure you've known by following the markets probably closer than I did through the day. And I will tell you, if you've not taken a vacation in a while, you should, only because not paying attention to the flickering ticks and then just having some time to reflect and look at the evidence, it's a totally different experience than watching it minute to minute as things play out, as you could probably guess. The S&P 500 pushed above 5450 into the close. That's up almost 10%. That's 9.5% off of yesterday's close. Obviously, kind of a choppy sideways day until the just kidding tariffs announcement that happened after 1 p.m. Eastern, causing risk assets to accelerate to the upside. The NASDAQ composite 12% higher, just above 17,120. Mid caps and small caps both up as well. You're going to see the breadth in a minute. The S&P 400 mid cap index 100% advances today. Literally no stock in the mid-cap index went down today. The VIX did go lower by about 19 points, still well above our threshold of high volatility, you think? Still up around 34, so still fairly elevated, but obviously quite a few swings here to debrief on. The bond markets overall, TLT drifted higher a little bit. It was a choppy day, but by the end of the day, rates had finished fairly strongly. Up higher earlier right out of the open, but kind of chopped around through the course of the day. Your 10-year yields around 4.4%, the 5-year point around 4.1%. Long bond yields not quite to 5%, but getting closer, around 4.8. The dollar essentially flat for the day. No real change there. Commodities overall accelerating to the upside, along with equities. The GLD, SLV, gold and silver, both up about 3.5% to 4%. Copper prices up 8%. Crude oil prices up 6.7%. Now, if you find yourself struggling to draw like broad conclusions from today's trading, I don't blame you. I'm struggling as well. And the challenge is, again, what you'll see when we look at the charts, and what I'm actually going to do in the chart review portion, by the way, is look at almost the identical set of charts we looked at on yesterday's close. I just want you to see how they've changed. In some ways, they've obviously changed quite a bit, right? The daily chart of the S&P looks very different than it did yesterday. There's no denying that. And we have to sort of think about new levels, which could have meaning. But a lot of stocks, even like a Tesla that was up 20% today, like the trend is still very much down. And that's the, sort of frightening reality of this kind of larger trend. There were a lot of things going wrong for stocks up until last Wednesday. It was a week ago when this whole tariff thing lit up. Before that, stocks are actually still going down quite a bit. It's just, it didn't feel like there was this big downside catalyst. So it almost reminds me, if you remember a number of years ago when crude oil like spiked up to $150 a barrel and then soon spiked lower. And it was almost like you could cover up that part of the chart. And the market had that like crazy hiccup, but then just kind of went back to the normal trend. I'm wondering if that's how this plays out. If this was a quick downside shock, a quick upside shock. And then we sort of, I think, realize as a collective group of investors, it's not like things got dramatically better. I mean, arguably, from a week ago, it's the same condition except a bunch of tariffs against China that have not been wound back yet. Again, I mean, drawing broad conclusions on short-term data is a fool's errand in a lot of ways, but we have to try to pay attention to it. Bitcoin, by the way, accelerating to the upside along with equities. So Bitcoin and Ethereum both up big. All 10 of the top 10 coins here moving to the upside. Bitcoin up about 9%, 83,000. Ethereum up 14% to 16,080. All 10 of these. So if I randomly pause and just stare at the screen, I'm literally trying to process this as I go through the charts with all of you. Just man, what an exciting period. All right, technology at the top of the list, up 13.4%. Consumer discretionary, the XLY up 11%. Industrials, communication services, materials all up 8 to 9%. The worst performing sector was consumer staples. That's still up almost 4% today. Same with utilities, healthcare, a little more than that. So, obviously growth sectors. And again, the reality is these are the sectors that have been beaten down a ton. If you look at returns for the last month, they're still not good, right? And that's the weird thing that happens when you look at percentages like this on a daily basis. It will give you this false sense that like everything's great and these things are up a ton. They're up a ton from yesterday's close. If you look, a lot of these things are still down a ton year to date, including the S&P and the NASDAQ. Again, nice bounce, 100%. Does this give me confidence that you want to be a huge buyer and ride this higher? Like, no. Personally, this feels like a monster overreaction to the upside. But who knows? I mean, this is the new world, right? All right, let's look at the breadth. This is what I mentioned. The breadth on the mid-cap index, 100% bullish. I don't know if I've ever seen that before. This might be a first. 98% of the S&P higher. 84%, the big laggard, 84% of the NASDAQ composite stocks moving higher. So again, this is a big update, pretty much everything getting a nice bounce here. Again, what I try to do in this environment is take a step back, when in doubt, zoom out, look at the longer term trends and how things are going. I still see a lot not to like with the general trends here. Now, obviously, this was such a significant move. If today was Friday, which it's not, but if it was, the short-term model would actually flip back bullish for me, which is certainly how it felt today. Medium-term still negative, long-term still bullish. So a secular bull trend is still, a medium-term trend still weak because that doesn't change on one day, but the short-term tactical trend going bullish. Boy, that may be where we end up. Obviously, big gains, of course, in the Magnificent Seven and Friends. Tesla up 23% today. NVIDIA up almost 19%. Same with Broadcom. These have been some of the weaker areas. Apple, and again, I mean, scratch your head with me on this one. Apple up 15.33%. The tariffs with China haven't changed from what I've seen most recently. I haven't checked in the last 10 minutes, so maybe something new happened. But Apple accelerating to the upside when their business is essentially getting torpedoed with parts from China. And there's no way Apple can just switch and start manufacturing iPhones in the US. And again, I guess what the market is pricing in is this is basically optimism that the China tariff thing is probably going to be the last one to change, and it's just a huge bargaining approach. And in the end, it gets better. But I mean, that would unwind everything that we've heard over the last week. Maybe, right? Wow. Okay. That's where we're at. Interesting to note, by the way, airlines, the top performing group today. Airlines up 22%. Automobiles, that's with Tesla and some others. Semiconductors up 19%. Those are your three top performing Dow groups. Airlines, And again, I mean, the problem I have here is airlines have been getting absolutely crushed because of a lack of demand for travel. It's not like demand for travel all of a sudden increased today. It's still really bad. A bunch of federal agencies have been absolutely gutted. They're not looking to fly Delta right now. Um, Interesting. I mean, listen, if you and I will tell you this, if you have ever caught yourself arguing with someone that the markets are efficient or that investors are rational, point to the last week and there's nothing rational or logical about some of these moves. Things that should not be going higher are going higher. This is a very emotional reaction. This is FOMO, I would argue. This is a FOMO driven rally of people getting really excited that like things are just good again. I don't see that. All right. Well, this is fun. Let's continue, shall we? Boy, I just wanted to go on spring break for a week, you guys. I just wanted to take my family to the Olympic Peninsula. We're going to go hiking. We found a new coffee shop this morning. I'm just trying to get some pastries, talk to some local people here, enjoy it. I'm just trying to relax. Anyways, all right, let's keep going here. Here's what the market carpet looks like. And I don't mean to giggle, but that's my natural defense mechanism when things are hard to understand. I just kind of laugh about it. I mean, pretty much everything in the S&P 500 up. If you were down today, I don't know how you pulled that off, right? If you're Dollar General, how did you manage to snatch a down day out of all of this? I don't know what was so special about Dollar General. Airlines that are lowering guidance today were up 20% today. So, man, that hurts. But anyway, so pretty much everything up, right? And you can see that in the growth sectors most notably. It's hard to tell the colors because everything's up so much. And the market carpet and most heat maps like this are not designed to scale to, I mean, anything above 3% is just the brightest green. So these are all homogenous, even though some of these should be like nuclear green, right? I mean, I'm talking, Seattle Seahawks secondary color green, whatever they call that crazy Nike green color, lightning, I think, or something. Like that's the kind of green you need for the up moves you're seeing on Nvidia up 19% or Tesla up 23%. But overall, obviously, all these stocks are up quite a bit. I don't know if I can nitpick much on this, but even defensive sectors were up a bit. Just not nearly as much. Obviously, the biggest recoveries were in these names. Now, here's the thing, though. I mean, if you look at the chart of Nvidia, I don't get an all clear things are great vibe from that chart, right? And we'll look at that. I think I have that one here in a moment that we'll look at. But as we go through these charts, I mean, I will try to encourage you, if at all possible, to keep a perspective, right? And just think, all right, now that this one crazy up day has happened after a week of crazy down days, which did not seem possible before last Wednesday, early before last Thursday, now all of a sudden we've seen the market can rip back to the upside as well. In the end, we haven't even recovered the down move from the initial tariff announcement. I don't think. Well, let's look at the charts. I don't mean to preview anymore. Let's look at the charts here and see what we found. I can see questions in, and I will take a question or two, and I'll answer what I can here. I don't know what answers I have for you today. The best I can do in an environment like this is tell you, man, I'm trying to go through these markets and navigate them with all of you, and we'll see what we can do one day at a time here. All right, here's the daily chart of the S&P 500. Let's start here. Let's see what happened to the chart. So I did look before, and on an intraday basis from the February peak to the April low, and that was the 2 days ago, we're all the way down below 48.50. That was a 21% drop from the intraday high mid-February to the lowest low from 2 sessions ago. Today, we've basically clawed back about half of that overall decline. We're up to around 54.50 and change, right? So about 11% off of those highs and a pretty nice rally off of the lows. This is 5,500. That was the 61.8% retracement level that we highlighted from the August low to the to the December peak, and using that as the framework. So that was support there in mid-March. That was today's intraday high. Maybe that's the new, resistance level to pay attention to. I'm certainly watching it here going into tomorrow's session. Here was the initial gap after tariffs. So that was last Thursday. Here was the next gap lower around 5,300. That's when, here it was like, okay, tariffs are bad, but maybe he's just kidding and he'll wind him back tomorrow. He did not. And all of a sudden people start to believe. Monday, we open even lower. yesterday was kind of a bath day, right? We opened higher but closed lower. Today, midday, he announces, all right, at least 90%, 90-day pause or whatever the language was, but essentially taking them off the table for now. We've basically recovered to the initial gap lower from the tariffs. So we haven't even erased the sell-off that happened after the tariffs were announced. We've kind of almost gotten back to that gap lower. So again, I mean, the chart is still pretty ugly. And again, what I'm wondering is if you draw a trend line off the February peak and the March peak. I'm actually liking this so much, I'm going to write it now, but we'll see. I reserve the right to adjust this as this crazy market continues to get crazier. But let's draw this line. Maybe this is the kind of line that you watch. I don't know if I need to make that red. Maybe we make that a purplish color, right? So like there's the high from February. There's the high from March. Maybe that's the level that we look at. And again, that's sort of the upper boundary to where, what I'm kind of thinking is you cover up this part and just assume that this was the trend pre-tariffs. This was the tariff shock to the downside. Here's the tariff shock to the upside. We're still below that trend line. And I think that's, for me as a trend follower, like that's what I'm going to. I'm looking at this and seeing, obviously, this is quite a crazy volatile stretch of 1 week. It's obviously big announcements causing things to come up and come down. But we're still, pre-tariffs, we were going lower, right? And we were trending down. We were breaking support. The tariffs just accelerated things very quickly, and so that's why I still see this I'm pretty comfortable still calling this a bearish phase. Again, today was just a huge counter trend move within that. We'll see what happens tomorrow. We'll see what headlines we get tomorrow. But for now, I'm guessing tariffs maybe quiet down a bit. Although the stuff with China still doesn't seem to be going away. And the problem is that negotiation or whatever you want to call this craziness continues for a while. I don't think the market rallies in that situation. This is optimism that tariffs are not going to be as huge of a deal, but they're still out there. So we'll see. This is one of the charts we looked at yesterday, looking at breadth, and just as a reminder, big bounce, but most stocks, 4 out of every 5 S&P members, even after the close today, are still below their 50-day moving average. So even basic breadth indicators that I follow are not giving that classic buy signal telling you we're getting better. Still less than half of stocks above their 200-day moving average. The S&P obviously still about 250 points or so below its own, 300 points below its own 200-day moving average. So I think there will be more to come before you can give any sort of all clear to this. All I think this last week tells us is buckle up for excessive volatility. I mean, excessive volatility is probably going to be the new norm. Bullish percent index. I actually did a video on this earlier today, which is probably not posted yet on Stock Charts TV, but hopefully will be very soon. Talking about the bullish percent index, we talked about the 30% level as being one to watch. Still we'll see if things continue to pop higher, but for now, no. Again, advanced decline lines, this was a big up day with most things higher, but the cumulative advanced decline line still clearly trending lower. So if you're looking for context from the show, which I hope you are, I mean, my goal is twofold every day, maybe threefold. Number one, tell you what happened today. Number two, try to put that into context. And what I mean is try to just take a step away from today's action. Think about what we learned overall. Think about what changed today. I think one thing that did not change today is excessive volatility. I think that's the norm. And then the third thing, just try to nudge your thinking and focus on actionable ideas or just themes and charts that'll make you think and just maybe reflect on what we're seeing here. This chart is one that I featured in that YouTube video as well on Stock Charts TV. Hopefully it should be posted very quickly. Talking about how breadth conditions are still fairly negative here. There's a lot more that we would need to see recover, I think, in terms of breadth, besides one day to tell us that things were changing. But again, for one day, big up move. Obviously a big up volume day, not the highest volume. That was on Monday's session, but today pretty decent. Chicken money flow still bearish, still negative, even with today's bounce. So we'll see what happens through the remainder of this week. Bond prices gapped higher today. And so the TNX, $TNX, which is 10-year yields, did break above this trend line resistance, did end up, going lower through the course of the trading day, but overall gapping above the 50-day moving average today. clearing this trend line, which maybe says we're in a period of a little higher rates, at least for now. We'll see if we remain above that trend line again tomorrow and maybe into Friday. What else can I tell you? I mean, note that the dollar really isn't going anywhere. From the gap lower last Thursday, we're literally in the exact same range that we were. So the dollar really hasn't changed a ton in the last week, even with today's move. Crude oil with a big bullish engulfing pattern. So obviously a lot of negativity being baked into crude oil prices, and also with with risk assets as well. Today, a big bullish engulfing pattern for crude oil. That tells you the next 1 to 3 bars most likely higher. Gold having a nice recovery day, closing back above $3,000 an ounce. I'm still in gold in a couple different ways, and again, I guess feeling good about that potentially. Bitcoin, for now, maybe bouncing off of the 61.8% level. We talked about that on Monday's show, sort of finding stability just above 74,000, which is that 61.8% retracement of that main upswing in the fourth quarter of last year. Maybe that's a floor. So buying Bitcoin with that as a stop, I get that. That is a good way of using, I would say, the technical setup as a way of buying in on a short-term bounce and for the potential for it to ride higher. I would feel better personally if it got back above the 200-day moving average. I think that was a painful breakdown back here, and we've struggled to gain a foothold back above there. The RSI still below 50 today, but again, nice rally, of course. Bullish engulfing pattern for Bitcoin as well. NVIDIA yesterday had that down day, coming back into the range of this 2-bar pattern, this candle pattern called the bullish piercing line. Today, of course, accelerating to the upside along with most technology. Breaking above a trend line here, just barely, though not by much. We're sort of an initial break above that trend line, taking the February and March peaks. NVIDIA is still, below 2 downward sloping moving averages. So again, I still don't see NVIDIA as a great chart. I see it as a very volatile and noisy chart, but still within a downtrend phase, I would argue, as a trend follower. Tesla, nice update. We're still not making a new high for the last 5 sessions, right? And so that's the reality. These things have moved so much and they've been so noisy. A huge update like this still doesn't break out of a range. Tesla is still between support at 220 and resistance at 290. That hasn't changed yet. So again, we could go further and break above 290 and break above the 200. I think that would be quite bullish. Not there yet. I'm not seeing it all clear yet. Here's that weekly chart of Apple, for now holding the 150-week moving average. We talked about that as a potential area of focus. So we'll see if that's able to hold for now. And again, I mean, the fact that Apple's rallying on what we learned today just tells you everyone's just holding the news and buying everything and just assuming this is the end. It's literally FOMO here. Given all the challenges to Apple business based on what's happening here, I can't imagine that's a great chart. It's not, I would say, for now. But we'll see. Apple for now holding support, right? 165. That was the low we talked about here. For now, it's holding above there. That's good. Any trend line I'm drawing Apple, we're still way below it. The momentum's still negative. Goldman Sachs, I highlighted this because this is, again, where earnings are going to come out. And again, there's so much sort of macro news flow, obviously, coming from Washington every day. It's hard to think about what's going to happen with earnings, but I think I think this is what could be the next big catalyst, is how companies are. And maybe this provide, again, we'll see what happens with the tariff headlines, of course, but, perhaps you start to see, negative earnings, and then that, starts to remind investors that, boy, the long-term impacts of some of these changes are very real and can't be erased very quickly. We'll see. AMD, of course, and this is another one, right? Counter trend bounce off of an oversold level, 100% true. And as we mentioned yesterday, right, stocks like this in downtrends oversold. Great opportunity for a counter trend bounce. A day like today is a great example of that. Is that an investment? I don't think so. I would say a chart like AMD has a lot more to prove before that looks like a constructive technical chart for the medium term and long term. In the short term, tactical rally off of oversold conditions, 100%. Weekly chart of AMD, and this is what I was talking about. For like an all clear, you look for buy signals from lagging indicators like PPO. Even a day like today, not enough to really change that longer term trend. I feel like the weekly charts may be really worthwhile to pay attention to in this kind of environment, and just look to try to put a day like this into proper context. Boy, that's the best I can do, trying to get my head around this sort of day. And again, the narrative changes so quickly. And again, this is what the problem is if you're applying the normal kind of low volatility 2024 toolkit to the current market. It probably feels like it's not working. You have to remember that aggressive swings are normal. Even things that should not be going higher because of long-term expectations are going to have big swings. And maybe that's what's happening with Apple, right? I mean, there's maybe no real reason to be optimistic at the moment, but the market's swinging because of a very irrational cohort of investors reacting to crazy headlines that are coming out. And we're going to see big moves to the upside. I think we'll see big moves to the downside as well, as we have. All right. Can we take a question or two? Then I'm going to go find a place to curl into a ball here and forget about the markets for a little bit. All right, seeing a bullish breadth thrust. A person, thanks for watching on YouTube. Seeing a bullish breadth thrust. Let's check on Marty Zweig's classic Zweig breadth thrust indicator. Maybe. Let's take a look. So in my breadth list down here at the bottom, Zweig breadth thrust. I haven't looked at this yet today. The Zweig breadth thrust, by the way, if you're not familiar with it, is a technical indicator created by Marty Zweig, who is a legendary investor, legendary strategist back in the day, decades ago. He's one of, this was a different era, but he was one of those where, you know, he would write a letter or be on TV. Really wasn't probably TV as much on the time, but you know, he would make an announcement and markets would move significantly just only based on his comments. That was the market moving potential of people like Marty Zweig, like Joe Granville and others. They would come up with a big outlook change and the markets would react aggressively because of that. So many people hung on his word. So a breadth thrust is where you have very negative breadth and then very positive breadth. Now, there are a couple different ways. I mean, breadth thrust in general are a kind of a catch-all phrase for when breadth is very negative and then it gets very positive in a very short period of time. Marty Zweig's version of a breadth thrust is the version that I tend to follow. And this is basically looking at daily price data. It's looking at advanced decline data. And basically the breadth needs to be negative, which means it's below 0.4. And then within 2 weeks, within 10 bars, it needs to go back above 0.62, which is the red line here. It's not close to doing that. This is a really long, sorry, I have like a 25-year chart here just to show those historical signals. Let me zoom in a little bit just so we can see what has happened most recently. So the short answer is no. It wasn't enough to register a breadth thrust. Certainly turned the breadth around very quickly. Basically what happens on this indicator is today the clock starts and you've got 9 more sessions to get all the way up here, which would mean it can't just be one bar, but it would have to be a number of other upwards, you know, moves in breadth. The last 2 signals we got were at the end of March of 2023, early November of 2023. So the indicator goes below 0.4, gets to at least 0.62 within 2 weeks. That registers a buy signal. So, you know, the rally today basically initiates the buy signal. The last time we had a swing higher was here, but it didn't clear the, you know, the 0.62 level within 2 weeks. So it didn't quite get to a breadth thrust. If that would happen, that would be one of those all clear signals I think would be important to watch. Maybe we'll keep an eye on this indicator. Thanks for asking about this, by the way. I hadn't even thought of that. It's one of the great things about this this sort of medium and being able to get questions from you guys. I appreciate it very much. Yeah, Marty Zweig, 3P investor. Marty Zweig was on Wall Street Week. You're absolutely right, with Louis Rukeyser. Great show. So I was not investing at that point. You know, I graduated from college in the year 2000. You may find it very easy to believe or very hard to believe. I knew nothing. I mean, absolutely zero about stocks until I joined Bloomberg, interviewed with Bloomberg and realized I needed to at least read something about it, started reading some books and then learned on the job. And then very quickly just found a passion for some of these things. So I didn't ever get a chance to watch that show. And the recordings are not very commonly or not very readily available, which is kind of a bummer. I wish something like that was around, sort of a different world. Jeremy, do you have any book recommendations? So listen, I appreciate that you're asking a question like this because my general thought with something like this is like, take a step back and see what we can digest. So I actually do. Here's your trick. Go to marketmisbehavior.com/reading list. I have a recommended reading list, and every one of these books I've read, I find them super helpful. They're in a couple different categories, and if you're looking to try to make sense of what's going on, let me do my best to point you to a couple interesting things. Number one, if I'm going to the investing section, I have to recommend Kindleberger's classic Manias, Panics, and Crashes. If you think about the bubble-like behavior we've observed in 2024, you'd sort of this latest technology bubble, the AI frenzy, being told that revenues don't matter anymore and companies with negative earnings should still go up and have ridiculous valuations. This book shows you how that pattern of bubbles and busts has happened so many times back to the 1600s with tulip mania in Holland. So I would definitely read that just to try to get your head around what we're seeing here. From the technical analysis section, I mean, I love all of these books. One that I would recommend that you maybe have not seen a lot, Michael Carr's book, Smarter Investing in Any Economy. That's all about relative strength investing, which I think in this environment, super helpful to pay attention to because that's how you're going to outperform the market. Within trend following, I just had lunch with Gary Antonacci last week at the CMT event in San Francisco. What an awesome guy. I mean, has had a fantastic career in the industry, really a quantitative mathematician, but loves digging into price data. And his book, Dual Momentum Investing, is something I try to reread like once a year. Just a fantastic, straightforward illustration of why price momentum works. Those are three. There are a bunch of other books on there. I recommend all of them because I think they're all good. I've read them and have enjoyed them quite a bit. So I would encourage you to take a look. All right, last question, and then we'll wrap it for the evening. Randall, thank you for watching on YouTube. Hi, Dave. When indicators react so violently in days like this, how do you balance the radical numbers an indicator might throw off? Elder Force, for example. Yeah, I mean, listen, this is tough, and I think the reality is, there's sort of a normal environment, right? There's a normal environment where there's not a lot of news flow, and that's where I would say then the markets are left to more supply and demand. There's not as much of an emotional input into buy and sell decisions as there is on a day like today. So things are kind of normal. So it's like the base classic technical analysis indicators kind of look normal, and that's kind of it. When I think back to my career, when you look at like the great financial crisis, when you look at the tech bubble, which actually was not that painful of a sell-off, it was actually pretty normal, but like 9/11 kind of moves where there were violent swings and a lot of uncertainty. The end of 2018 with a big sell-off, the COVID move, that will always skew indicators and make volatility, obviously elevated momentum indicators, volume indicators, all of a sudden get crazy movements. And I remember at one point, and this was coming through the financial crisis in like 2009, 2010. I remember talking to some of my analysts at Fidelity and debating whether we should ignore some of those readings because they were kind of fake, right? It was sort of like these artificial moves. Like, should we really think of that as part of the history? And the reality is you kind of do. Now, there were some things that we did to adapt those indicators. And as we go on, I'll probably try to highlight some of those for you as we go through the evidence day in, day out. But I don't think you can just ignore these sorts of signals, right? I mean, severe signals to the upside or the downside are part of the story of this market that's being written overall, each day at a time. So focus on that evidence. And again, just the best thing I found to do in this sort of environment is look back to previous lows. So I would say this is a really good time to use a platform like Stock Charts or whatever platform you use. Bring in as much history as you can and look back to the COVID period, look back to 2022, look back to 2007 to 2009. Not that I think we're necessarily going to repeat that, but that will give you a period where you've had accelerations to the downside, big counter trend moves to the upside, and a lot of the volatility from point A to point B. That's how you sort of develop a playbook to deal with these volatile markets, trying to find some sort of low. Folks, that'll do it for today. Thanks for tuning in a little later than normal again this week. I'm just trying to be on vacation, enjoying a little rest and relaxation. My wife has been super understanding, my son as well. They all say hello, but have been very kind to say, look, if you need to jump in and do a show or do an email or talk to premium members, do it. So I'm trying to balance things as much as I can, but these are crazy times. The best thing I can tell you is When in doubt, zoom out, use technical analysis. Don't ignore signals. Just think about how charts and how patterns have evolved in previous bull and bear cycles. And hopefully you'll have a good sense of where to be positioned for tomorrow. That's it for today. I'm Dave Keller with Market Misbehavior. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.